I'm Nancy Hipschman. I'm a managing principal at Sullivan Cotter, and I lead our Division C3 nonprofit consulting group. As a tax-exempt organization, the board and its leadership have an obligation to pay reasonable compensation to its executives, considered disqualified persons under the tax code. And we're seeing a trend recently in executive turnover, particularly at the CEO level, and paying reasonable compensation in the final year of an executive's tenure is paramount to this discussion. And when we talk about reasonableness, here we really mean reasonable total compensation. It's an amount that would ordinarily be paid for like services by like enterprises under like circumstances. And while the IRS has no bright line test for determining reasonable compensation, we really do rely on the market data for similarly situated roles in similar circumstances to ensure that what is paid falls within the range of what would be typical. And in the cases of involuntary termination, ensuring reasonable compensation is among one of the easier circumstances because there's a lot of market data available to understand just what is reasonable. For example, a 12-month severance period covering both salary and benefits continuation is fairly typical. What would not be so typical is including additional cash compensation, bonuses, or the continuation of retirement contributions during that severance period. And in the case of voluntary termination, such as when an executive retires, this is where we see some boards dipping their toes into some potentially choppy waters. And those choppy waters often take the form of either wanting to make up for past years of underpayment of compensation, and that might take the form of, say, a below market salary over many years, or lower than normal or typical retirement contributions over the tenure of the executive. If you have a CEO with a planned retirement, or a CEO, say, within 5 years of retirement, and you find yourself thinking, we should have done more in the past, or we want to do something to really express our gratitude for their contributions before they leave, you want to be asking yourself two things. Is what we want to do what would normally be paid for like services from like organizations? Are we doing anything that might be considered unusual, like allowing someone to take a sabbatical at the end of their tenure and not return to the organization once that sabbatical is complete? We often see that when an organization has a paid sabbatical program, which is in and of itself not that common. But we also see several ways that paid sabbatical programs taken at the end of an executive's tenure can become problematic. And the second thing is, does total compensation, both cash and benefits, fall within market when you include the payment for the benefits that you're considering? So remember that reasonableness of compensation is considered on the basis of the time period over which it's earned, not when it's paid. So a $500,000 payment to say thank you at the end of a tenure would be more reasonable if it was put into place 5 years ago versus 5 months ago, as that amount can be attributable to earnings over a longer period of time, thereby reducing the annualized amount that will be tested for reasonableness.